Yeah, welcome back. It's time to talk trade finance. Now, the African Development Bank has signed a $100 million agreement with Commerzbank of Germany, which it says will help address critical market demand for trade finance in Africa. Zan Meyer, he's head of Africa Business at Nedbank Capital, is joining us now to unpack some of the challenges in trade finance in Africa. I actually don't want to say challenges. I want to say trade finance opportunities, because when you look at the African picture and when you look at Africa's demands for growth and development, particularly funding around infrastructure, there's huge opportunity there. Let's talk that overall African picture for trade finance. It must be looking fantastic for you guys.
Godfrey, I think the choice of words in terms of opportunity is 100% correct. However, I think there's still a misconception that trade finance opportunities are fraught with peril. It's a lot of risk in Africa, and that bankers should stay south of the Limpopo to guarantee their bonuses. and I think that's a danger. And if we address the risks and really unpack what is out there in terms of trade finance opportunities, one comes to the conclusion that if managed correctly and understood correctly in terms of both the country and the commodity, as well as your client that you're dealing with, there are ways and means to mitigate risk and still do lucrative financing transactions.
So there's the story that I just read now. Those kind of stories help, because now you've got a foreign lender who's looking at Africa and providing that trade finance. And then at the same time, you also have an institution like the African Development Bank, AAA rated by all the major rating agencies, coming into play and providing the bedrock of support that's required.
That for us is brilliant news, and we find it encouraging that it happens. Both IFC and African Development Bank has done tremendous work in this arena in terms of almost providing incubator funding for trade finance.
So when do we begin talking about Africa and not use the word risk? I remember when we hosted our debate in Davos, we spoke about de-risking Africa, and there was criticism from some quarters because they said we were perpetuating the myth that when you come to do business in Africa, there is a lot of risk. Let's talk about that risk environment. Just how different is it to other parts of the world, and what's being done to take it away?
I think there's a number of issues that one needs to understand trading in Africa that makes it unique. And you know, if we look at Africa having 12% of the world's population, but only contributing 1% of the world's GDP, you must see that there's a problem. Now, I would like to break it down and say, you know, if you understand the country, the environment you're dealing with, and all the countries in Africa are different.
But like your basics, when you go to do business in other parts of the world, you must understand the country, you must understand the people, 100%. You must understand the culture.
You understand the commodity first and foremost, and I think that's where the intricacies in Africa comes in. Is to understand the risk of the commodity that you're financing. And we're sitting with perishables, we're sitting with iron, we're sitting with coal, oil and gas that recently been found in the Eastern African corridor. And I think that for us is a challenge in terms of getting those commodities out on time and retaining value. And I think that's where the infrastructure development comes in, which is crucial for effective commodity trading.
The infrastructure is both an opportunity as well as a key challenge that needs to be addressed, isn't it?
Because the world is keen to do business with Africa. It's just very, very difficult to maintain and guard against lapses in delivery. And I think that's where the issue comes in.
So how do you address it then? How do you take into account that risk that emanates from your infrastructure play? Because we know that there are now efforts that are being made at both a continental level as well as at financial institutions like the World Bank, like the AFDB, to address that infrastructure deficit. The numbers have been banded around. 93 billion is required every single year. We know there's a deficit of $50 billion every year.
100%.
How do we address it?
I see one of the solutions is public-private partnerships. It is the incubation of capital and debt markets. And we've seen success there. We've seen Kenya, East Africa is very good at actually developing that debt markets in terms of bond issuances. Ghana and Nigeria has had successes recently. The fact of the matter is you need to cater for both commodity imports and exports. And I think it starts at port congestion. A lot of our clients in Africa are basically already pricing in a $10 to $20 a ton premium for port congestion and demurrage charges. That is disastrous in terms of pricing of commodities in Africa.
Let's talk about the margins that you guys get when you finance trade in Africa. How are they compared with what other people are getting in other parts of the world, before we talk perhaps about how to mitigate some of the risks that are there?
I think it comes back to pricing for risk. And if one understands the situation, the clients, the commodity, and again, you know, the environment that you trade in, it's almost it's a like-for-like scenario. Generally, if one would make the analysis, then pricing in Africa would be a bit more expensive because you price for political risk, and generally banks would like.
Is that still a big factor though? Because we have seen elections coming into play. We have seen efforts being made to say to the soldiers in the barracks, you guys, you stay right where you are. We want people who have been elected by the people to be running their governments.
You know,
it hasn't started filtering through, you are saying?
Yeah, the common misconception is still that Africa is one country.
Okay.
And obviously South African banks are understanding that we need to risk and rate every country individually in terms of political and long-term stability outlook.
How big are those margins, though? Are they still wider than other parts of the world? How big are they?
No, I wouldn't say so. We've seen margins contracting, but having said that, we are also selecting our client base very, very carefully. And Basel III is something that did that to us.
Yeah.
And generally, I think it's a step in the right direction.
When you say you've seen margins contracting, what do you mean? Is that substantially? Is that incrementally? Is that tiny?
No, I would say it's not an incremental step. It wasn't exponential in any event. I think it was more a careful approach from banks to structure facilities very, very risk averse, and that obviously leads to a reduction in pricing.
Yeah. Let's talk about the opportunities there. You spoke about opportunities being in the commodities front. So we know Africa produces everything. So you've got oil, you've got your platinum, you've got your copper, etc. Where would you go? What would you look at?
I would at this stage like to maybe concentrate on something that the world needs, which is food. Agricultural production in Africa is on the step up, and if you look at the agricultural component of the commodity sector, it's growing rapidly.
Yeah.
What we've seen in the recent times is the international traders in agricultural commodities investing heavily in African infrastructure, just to make sure that the ports can accommodate exports of agricultural commodities.
Yeah.
Demand in India is rising and increasingly rapidly, and although we've seen a bit of a contraction in the market for instance, our citrus exports in Europe, that is being picked up by the Chinese market and the Indian market.
And Africa has got the land.
You're 100% right. We've got arable land with plenty of water resources. The lack of storage, infrastructure, and port infrastructure is just hampering that development.
In terms of countries, where are you seeing that opportunity? Particularly, as you say, now we spoke about commodities, we spoke about infrastructure potentially being fixed as well, and we spoke about now the food side.
Yes. It's difficult to just highlight one or two countries. It would be
everybody says Nigeria.
Yes, Nigeria is the obvious choice. I think in terms of agricultural production capability and potential, Zambia would come up number one. And a lot of infrastructure investment funds agree with me on that. Zambia has plenty of water resources. It's a stable economic environment. And at this point in time, their commercial agriculture has picked up tremendously with South African investment coming in there.
Yeah, I'm thinking Mozambique as well. I'm thinking 100%. Zimbabwe potentially. I mean, I saw some numbers coming from one of their retailers, top retailers in the country, OK Zimbabwe, and they're showing a tremendous growth. I mean, 16% in revenue growth.
You talk about Zimbabwe, you talk about Mozambique, you're 100% correct. With the calorific intake that is increasing exponentially because of the mining activities in, for instance, Mozambique, you'll have to feed those people.
Yeah.
And the influx of South African farmers now farming in Mozambique just tells you that the need is there, the demand is there, and then that's where the opportunities lie at this stage.
Yeah, we didn't talk about the legal frameworks because potentially that's another area as well that needs to be addressed, but that's a conversation for another day. Zan Meyer is head of Africa business at Nedbank Capital. Thank you for joining us.